Here's what's coming up on The Retirement Architect with David Reyes, your retirement television.
So bond funds are kind of like a little bit of, mystery stew, right? We have no idea what's going on.
I don't like mystery stew, by the way.
I don't either. But the fact is, so we're just not big fans in general, but they have their place. So that's one way I see a lot of unnecessary taxes on the income side, but also what about if you have a large estate? What if you sell a piece of real estate? We have a lot of experience in helping people sell highly appreciated real estate assets and showing them ways to defer the tax. Yeah, so part of our second opinion process, which we do for every client, we do a risk assessment, we do a fee assessment, and we actually give everybody, regardless if they hire us or not, a full retirement income plan. They change jobs and they work for XYZ company and they roll that money into another 401k plan, which they've just locked it up again in a lot of cases. So you always want to, whether you're working with an advisor or not, move that to your own IRA, individual retirement account, and you won't pay tax, there's no fees to do that. It just gives you more flexibility and more options.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Hi, San Diego, and welcome to this week's show.
Stay tuned, we have 30 minutes of great information just for you.
Don't go anywhere, the show starts right now. Hi, and welcome to this week's Ask the Architect, where you email your questions into us from all over San Diego, and we answer them right here on the show. David, I have some great questions this week, and my first one is from Joanne in Solana Beach, and she writes, I'm recently widowed and very concerned about keeping my money safe. Where can I find safety and security in today's market conditions?
Well, thank you for your question, and sorry for your loss. We deal with a lot of single female clients, widowed, divorced, unfortunately. And that's a challenge. And so typically in a safer environment, you want to have investments that have some guarantees involved with them, some principal protection, some income guarantees. And so that's where I would start and then kind of build a portfolio from there.
I'm really glad that you bring that up, because we talked about this in a previous show, that I'm just going to go from the data standpoint because I don't want to offend anybody. But the data indicates clearly that in a marriage, the man will be the first to pass, which means that there really should be, and I throw a challenge out there to couples, the pieces need to be put in place, David, so that when one passes, and the data clearly suggests that the man will pass first, that all of the financial components of their marriage transition smoothly to the spouse. Is this something you do at your firm?
Absolutely. When we do income planning for our clients, the first thing is surviving spouse. Right, and so Social Security, you're going to lose one of the Social Security incomes. You're going to lose a pension income potentially. So absolutely, we have to always worry about the planning really for the surviving spouse. That's where the planning starts from, right? Because there can be more risk for one or other of the spouse depending upon Social Security, depending upon pensions. Absolutely, it's number one.
Thank you. My next question is from Sergio in La Jolla, and he writes, David, our advisor hasn't called us in over 2 years. Is that normal, and how often should someone get together with their advisor?
Well, thank you for the question, and sorry to hear that. That's quite common. Most advisors that when I come across, because we're always competing against other firms, the communication sometimes is lacking. Not always, but it can be, and it's one of the number one frustrations for a client because they feel like they're in the dark or they don't really care. I would say at least once a year is at a minimum to meet with a client. From our firm, mostly about 2 times a year. But first I would just reach out to the advisor and let them know you're concerned about it. But it's just unacceptable. Especially if you're looking at your retirement planning and there's lots of moving pieces with the taxes and Social Security and pensions and things like that maybe need to be monitored, that do need to be monitored. And so communication, should be much more prevalent than that, for sure.
Especially with all those changes. Hey, listen, I would even ask this question. Are they still in business?
Yeah.
If nobody has reached out to you, not even for an administrative question over 2 years, it might be time to find a new advisor.
Yeah.
Last question from Rick in Poway, and he writes, David, on a previous show, you talked about bonds and interest rates. I have both bonds and bond funds. Am I safe?
Rick, unfortunately, no. You're in the crosshairs right now. I mean, bonds are actually one of the worst asset classes this year. Rates are rising. Inflation is, in the 8% range. I think it's a lot higher than that. But the fact is that one of the worst investments during inflationary times or rising interest rates is going to be bonds. And unfortunately, half of America's assets are in bond funds right now. So bonds, individual bonds are better. Most people don't own individual bonds, but bond funds themselves are going to be the worst because they're going to, with a bond, you actually, if it's a treasury bond, you're going to get your money back at the end of the term, right? Corporate bond, you may or may not based upon the company. Bond funds, you're not getting that. So the fact is you may lose more money in a bond fund, have more risk in a bond fund, but regardless, bonds as a large piece of an asset class right now for investors is very dangerous and risky.
I have to bring this up because I know that there will be people watching saying, geez, do I have bonds or bond funds? Because the bond, like you said, it has a maturity date. I know what's going to happen in a certain time horizon, but the bond funds, no maturity rate. So there's and it's a bond mutual fund.
Yep.
There's a lot of things that could potentially happen. And you were thinking, well, this is a conservative investment and I should be safe. I'll hand it to you from there.
Yeah, I mean, really, if we're going to have our clients invested in bonds specifically, we want to use individual bonds because then we can look at the company. We want to invest in a GM bond or a Google bond, or do we want to be in it, right? We can actually pick the bonds, and we know the duration and maturity. We want to own individual treasury bonds. So bond funds are kind of like a little bit of, mystery stew, right? We don't have no idea what's going on.
I don't like mystery stew, by the way.
I don't either. But the fact is, so we're just not big fans in general, but they have their place. Okay. So it's not like they're totally useless, but just right now, they're just an inordinate amount of risk, historical risk. The amount of movement in bonds to the downside this year, it hasn't happened in 20, 30 years. So it's just a good time to have that reevaluated.
David, thanks so much. If you want more information about anything we spoke about here today, hey, pick up that phone right now and give us a call in the office or go to our website. And don't go anywhere. We'll be right back.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Are you unleashing the possibilities of your assets in retirement? Hi, I'm David Reyes with Reyes Financial Architecture. As a retirement and investment advisory firm here in San Diego, we've helped countless retirees and pre-retirees create a cohesive plan to maximize their assets and, most importantly, their cash flow in retirement. Call 866-REYES-PLAN right now to schedule a complimentary second opinion review. And remember, you retire once, we retire every day.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Hi, San Diego, and welcome back to the program here on 600 AM. We are with the Retirement Architect. His name is David Reyes. He is a best-selling author, TV personality, and of course, host of this show. David, we have a big topic to talk about today. And in fact, this is what it's all about, getting a second set of eyes to look at what you have right now. Hey, maybe you're going to tell him, David, you know what? Whoever you're working with, they did a heck of a job.
Absolutely.
And you're good to go. But on the other hand, you might spot some things that are critical to making sure that that person's retirement or that couple's retirement is put back on track. And the first thing that I like to talk about is risk, mitigating risk. What do we do with that at Reyes?
Yeah, so part of our second opinion process, which we do for every client, we do a risk assessment, we do a fee assessment, and we actually give everybody, regardless if they're hired or not, a full retirement income plan. And so that's a lot, right?
That is a lot.
We used to charge for that, quite honestly. And several years ago, I decided that's probably, it'd probably be better not to. And it's been great for clients and for our firm. But we've done second opinions for 20 years now. I mean, we built the firm on second opinions, right? And the fact is that, again, we don't charge for it, so it's nice. But the fact is that everybody should take advantage. If they have significant assets, the fact is that they need to look at. Most people don't understand the risks that they have. They don't understand the fees they're paying. They don't have a written retirement plan. So the fact is that that it's fundamental, especially forget even about fees and the risk. And I mean that's important, but the income plan is the most important. So if I had to have a hierarchy, the written income plan is the most important because the investments are going to be derived from that. Most people have an investment plan, but no income plan, and it's backwards. And so, the pretty little statement that they say, oh, here's your plan, it's not a plan.
Risk comes in a lot of buckets, right? There's interest rate risk, there's fee risk, there's taxes risk, there's all these different risks. It's not just the stock market. So what do you look at when someone comes in, you do a second opinion? What exactly are you doing to mitigate risk? What are you analyzing?
Well, I'm looking at, so the first thing is people have to understand our meeting processes can be 3 to 5 meetings. I mean, we intentionally, I've made meetings longer now, not the meetings itself, the meeting process longer, because first off, I want to get to know the client. I want them to get to know me, right? So you can build that trust and, hey, can we really work together? It's important. So it can be sometimes 3, 4, 5 meetings before we get a plan done. And the fact is, so first off, you have to educate people on what they have first. Most people don't understand what they own. So that's just the meeting of itself. And then when you do that, you say, okay, here's the risk associated with what you have. Here's the income that's being produced from your portfolio. Again, that 60-40 portfolio is producing less than 2% of cash flow, or a cash flow firm. That's not enough. We need about double that. So that's the first part we go through. Then we do a fee assessment. Most people own mutual funds. So we're going to look at, we have software that will analyze what the actual internal and external cost are of the funds, typically between 1% to 3% in total cost, a lot higher than people think. And then we're going to do that fully, full written retirement income plan that includes Social Security, taxes, pensions. What if one spouse predeceases the other? What's the survivor's income? All those kind of things that people think about, but they don't have a game plan to do that.
Yeah, and I always like to bring this up because there are people sitting at home right now, listening, watching, saying, oh, I have a retirement plan. I get a quarterly statement. It gives me a pie chart and a graph, and it says this percentage. That's not a plan, David, is it? That is some speculation, and I joke and I say it's wrapped up with a little bit of hopium.
Yeah.
And what is an actual, I want you to take a minute and talk about, hey, that's not a retirement plan. This is what should be in your retirement plan.
Precisely is going to, if you looked at, what's funny is my wife, who's my partner, she's a CPA as well, so she's great. But she does all of the back, I'm not the smart guy, she is, right? She does all the planning, I'm just the figurehead, right? But she does all the planning, beautiful spreadsheets and all that. And what's fun is we came up with, over the years, we've used it for almost a decade now, and we have everything on one spreadsheet, right? We don't use fancy software and stuff like that. We use for some things, but I found that it's people love, so their whole life really is kind of on one spreadsheet, right? So we're looking at we have a column for Social Security, got a column for pensions, got a column for what the investments are going to be. Usually it's 2 or 3 buckets of investments, right? And then what are the taxes? The actual tax, we calculate what they're going to be in retirement, right? Because they're going to be different taxes when they're working versus retirement. No more contributions to 401ks, things like that, pension contributions. So what's nice is in one page, you can see everything. And we get comments all the time on a spreadsheet. It's kind of funny.
Listen,
people love, wow, I love your spreadsheet.
Beautiful,
think about
simple,
that.
right?
Yeah.
I don't have to storm through 64 pages of a template where all they've really changed is the name of the client.
Called the phone book, right? Exactly, the phone book.
The simplicity of this is, if for no other reason, pick up the phone right now and see your whole life, your whole retirement plan on literally one spreadsheet. What could be more wonderful than that? Hey, pick up that phone right now. Get David's eyes looking at your portfolio. Have David and his team create for you a complimentary second opinion analysis. That could be the difference between a good retirement and a great retirement. 866-REYES-PLAN, or visit us on the web at reyesplan.com. Hey, don't go anywhere. We will be right back.
You're watching The Retirement Architect with David Reyes, San Diego's Retirement Television.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan. Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no obligation, full-blown financial review today.
You're watching The Retirement Architect with David Reyes, San Diego's Retirement Television.
Hi, and welcome to this week's Retirement True or False. David, I have some great questions this week. Are you ready?
I'm ready.
Here we go. Question number 1. Rolling your 401k into an IRA after you leave a company could give you more options to fit your retirement goals. True or false?
True. Absolutely, yeah. One of the biggest mistakes I see people make is they retire and they leave their plan there, or they change jobs and they worked for XYZ company and they roll that money into another 401k plan, which they've just locked it up again in a lot of cases. So you always want to, whether you're working with an advisor or not, move that to your own IRA, individual retirement account, and you won't pay tax. There's no fees to do that. It just gives you more flexibility and more options for sure.
So it's a good rule of thumb, hey, if you leave a company, your money shouldn't stay there as well. You need to roll it somewhere, but not into another 401k. And the reason for that, just like you said, is if I roll into an IRA, I have a ton more options than just 6 or 7 mutual funds, which chances are, correct me if I'm wrong, David, but there could be some high fees associated inside the 401k, right? Plus, you're no longer taking advantage of the dollar cost averaging. If it goes down, you're matching the numbers. So why would anyone want to leave their money behind?
You know what, there's actually an answer to that, and because I asked clients that, but over the years doing this for a long time, is because they don't know what to do.
That's the
reason.
So they feel,
so they feel safer, I'm going to put in the company plan, and somehow in their mind they think that's better because at least it's there and it's with the plan and they know what they're doing. But that's why they probably need an advisor to feel confident to move it to an IRA to help them manage that money. That's the reason.
You know, and there's a magic number, and if you didn't leave your company and you're 59 and a half with your 401k, chances are you might be able to
roll it anyway, yeah. So 59 and a half and older, you can move your 401ks to IRAs, and we do it almost every week. We're moving, clients that are still working. You still can contribute to your 401k plan. It's just like sweeping the cash out. It goes to an IRA, no tax, no fee. Comes over, we manage the money, and we still contribute and help the client to manage their 401k plan at work as well.
Penalty for taking that up?
Not at 59 and a half.
So why wouldn't somebody do that? Why would I leave it all in there? Even though I'm working there, right? Why wouldn't I leave it all in there?
Well, 2 things. A, again, they're scared to move it because they don't know what to do with it. That's the number 1 reason. And number 2, they may think pay taxes. A lot of people think if I move my 401k, that I'm going to pay taxes. So just kind of the fear of the unknown.
Gotcha.
So consult with an advisor and see if it's appropriate to do that.
Okay. And my last question here, David, is it's never too late to get a second opinion about your retirement plan, even if you've already retired.
True, absolutely. Yeah, I will tell you the majority, our average age of our clients probably 67, and most of our clients are already retired when they hire us.
Right.
So, I wish they talked to me, 3 or 4 or 5 years before retirement. Doesn't matter. So absolutely, any time is time to get a second opinion, especially if you've had the same advisor for many years, or you're unhappy, or you've been your own advisor and you want to just say, hey, am I doing the right thing? I tell clients, if there's a few things that change, you're going to be okay. I'm not going to have you move money, do all this crazy stuff, and that happens sometimes. So I promise people, at least you'll learn something. I guarantee that. And if I can help you, great. But if not, at least go through the process and learn the things that we just don't know we don't know.
And I'll tell you, what's the harm in a second set of eyes, an educated, experienced second set of eyes to review everything you have? It's kind of like I got an x-ray on my knee. One doc told me this is what I need to do. Well, you know what? Before I do the surgery, let me talk to another one. What is the harm in that?
Absolutely. And you only retire one time, right? It's like your knee surgery, right? You can get the one time. You better get it done right. So you're probably going to get at least one more second opinion on that.
Are you telling me that retirees don't want to go back to work?
No.
Oh, here's the one I love the best, David. Move in with their kids.
There you go. There you go. No.
Absolutely not. All right, David. Hey, thanks so much. If you want more information about anything we spoke about here today, or even better, you want that second set of eyes with a complimentary second opinion, hey, pick up the phone right now. Give us a call in the office, 866-REYES-PLAN, or go to our website, reyesplan.com. But most importantly, don't go anywhere. We'll be right back.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Now more than ever, it's vitally important to review your current retirement plan and get an educated second opinion. Hi, I'm David Reyes, and for many retirees and pre-retirees, this is a very confusing time. As a family-owned business right here in San Diego, we have educated hundreds of families on how to retire with confidence in all market conditions. So let us help you. Give us a call at 866-REYES-PLAN for a complimentary second opinion. And remember, you retire once, we retire every day.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Today we're going to talk about the 4 thieves of your money. That would be market losses, high fees, unnecessary taxes, or low and no returns. So all these things are kind of attacking your money. Another one we could add in there today is inflation. We have inflation today that last we checked was around 8%. And so, on top of other things such as market losses, taxes, things that we're talking about on here, and high fees, inflation, if I would add on here as another one. We haven't experienced high inflation like this since the early 80s and late 70s. So kind of one at a time. High fees, that's probably the biggest area where I see clients, prospective clients, kind of getting overcharged. And typically it comes from 2 sources. A, mutual funds, and variable annuities that I look at. So mutual funds, I've seen mutual fund fees as high as 2%, 3% plus. That's including trading costs, other fees, hidden fees, a term called cash drag. We do a whole analysis, part of our review process on fees. So our job as a firm is to reduce the internal fees of your investment as much as possible. And so part of that too, we also look at annuities. So sometimes people have variable annuities inside of their contracts or inside of their investments. And variable annuity fees can be as high as 3 to 5%. Think of that per $100,000, that's $3,000 to $5,000 a year. I had a client just the other day, had $1 million annuity, okay, a variable annuity. His fees were almost $50,000 a year. Unbelievable, about fell out of his chair when he saw this, and that's not uncommon. Again, 3 to 5%. When you make that real dollars, it's a little more important, right? So again, high fees are an issue. Number 2 is market losses. I would put this in order, market losses, in the sense that going through financial crisis, COVID crash that we went through, the 2000 tech wreck, things like that. You have bonds that are really crashing right now. Long-term treasury bonds, a different risk, have been down as much as 20% this year. So market losses in general, whether it's stocks, whether it's bonds, with other investments, that's a big deal, because as we get into retirement and start taking distributions of those assets, the most important thing we want to do and solve for is never run out of money, right? We have a saying, we want the most amount of income, least amount of risk, and never run out of money. So fees are a big one, market losses are a big one. The way you run out of money for sure is taking money out of assets that are crashing, right? Because then we're not going to have the money. I know a statistic because I remember it. In 2000, if you took out 5% of your portfolio with 3% inflation, you ran out of money in 2013. So in 13 years, you ran out of money. We had 2 market crashes of 50% plus. You're taking out that 5%, which seems harmless, plus inflation, we ran out of money. Okay, so we want to make sure we mitigate our fees in here. We also want to make sure that we are going to have some ways to protect capital, and also taxes. Taxes are a big one. So one of the issues that I see quite a bit is that we don't have a plan for distribution, meaning that our IRAs are 100% taxable. Right? So every dollar you take out of an IRA or 401k plan is going to be 100% taxable, ordinary income tax, just as if you were earning those dollars at work. And what we want to do, if we can, is create tax-free forms of investment income, and also capital gains tax, which is lower. So we want to diversify. We talk about diversification of investments. We also, as our firm, is going to diversify your tax base, right? So taxable, tax-free, tax-deferred. So that's one way I see a lot of unnecessary taxes on the income side, but also what about if you have a large estate? What if you sell a piece of real estate? We have a lot of experience in helping people sell highly appreciated real estate assets and showing them ways to defer the tax. Okay, so lots of things as a firm we're dealing with and that I see as potential problems on the tax side. So low or no returns. Part of low returns or no returns is when you have market losses, right? Or right now, if somebody has an inordinate amount of bonds in their portfolio, they've lost a lot of money. So most of the low or no returns comes from market risk, where you're trying to get back to even. Like if you went through the 2008 financial crisis, it took you about 5 years to get back to even. Okay, so again, important topics, the 4 thieves of your money. The 5th thief I would say right now is inflation. So if you have any questions about these topics or anything I talk about, please feel free to reach out to us or go to our website.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Yes, I've been very blessed, a great family. I have 3 kids. My kids are 8, 12, and 18. My first child going to college. Luckily she's going to be home in Southern California. She's going to a Christian school. She was very blessed to get both an academic and a soccer scholarship. So we're very proud of her. And financially it helps, right? pay the bills a little bit. But yeah, my middle daughter Taylor is 12, plays basketball. Awesome. She's not the athlete of the family, but she's kind of the puppy dogs and butterflies. But we got her out there and she's playing, loving it. And my youngest son, David Ryan Reyes III, right? We kept the name. He's a big baseball fan, plays travel baseball. He's on a couple different teams, and I've been teaching him since he was 2. So we're kind of a sports family. Soccer, basketball, and baseball keeps us really busy. But besides that, really involved with our church and enjoy that part of our lives and just community. So that's a big important piece above and beyond God and my family. It's my clients. So I guess in that order. My wife, an amazing woman. We've been together for 18 years now, and she is now a partner in the business. She was a CPA by trade, then got into real estate for a long time, and was very successful, one of the top agents in San Diego, actually. So very bright woman. Takes a lot of things off my plate, and just a wonderful wife as a person, a wonderful mother, but a great business partner. And so I'm just very, very blessed to have her as part of our team and part of my family. Yeah, I grew up in Sacramento, and just fortunately met a friend of mine that I was either going to want to go to law school or become an advisor. And I met a friend of mine who is a great friend, Dan, and he said, David, I was thinking about being a lawyer too, and I became a financial advisor instead, so I'm glad I chose that path. But the nice part about it, when I was in the mortgage banking industry to start, and when you help people with the financing of their house, it's like the escrow period, right? You work with them for 30, 60 days, and then you're done. And I'm much more of a relationship person, I found, and I enjoy the years of I've had clients now for 20 years in San Diego Plus. And so, that's the enjoyment of that I get, that I didn't get out of a different business model, which was still in finance and dealing with numbers and things like that I enjoy. But having the personal relationships that are long lasting is I think the biggest joy I get and the biggest reason that I enjoy what I do. I think the biggest difference in our, philosophically with what we do with retirement planning, first off, it's all I've done for 27 years. I mean, it's just all I focused on is retirement income planning. And believe it or not, that's a very niche part of planning, part of investment management, part of planning in particular. And so it's fun to be able to really help clients. I always say I built the business for my clients. So everything we do for our clients. We've expanded our offerings because, with our attorneys we have in-house, our CPA firm we work with in our building. And so just because that's what clients need. We help people with real estate because people will sell real estate. They don't want to pay the taxes, so we help them to reduce taxes. Selling their business, one of the biggest problems is you're going to pay taxes. So those kind of services that we offer, I think, set us apart quite a bit. The planning part's the easy part. Getting to know the client is probably the most fun, quite frankly, because once I know their story, then the planning becomes easy because you're just giving them what they want, right? Which is generally just having that trust in the planning that they know everything's going to be okay.
You're watching The Retirement Architect with David Reyes, San Diego's Retirement Television.
Thanks so much for watching this week's show.
And if you want more information about anything we spoke about here today, give us a call in the office or go to our website.
And remember, you retire once, we retire every day.